There's rain. Are you listening? In the lane.
It's a wild time we're living in. Inflation is through the roof and the stock market is looking like a bloodbath, especially fintechs. This affects a part of SoFi's business, aka the lending segment that just reached an all-time high net revenue of $215.5 million just this last quarter's earning. Recently, the Fed has just released a proposed rate hike schedule, so make sure that you have your seatbelt on because SoFi could be in for a bumpy ride with the increasing interest rates next year. In this video, we'll be going over how interest rates next year will affect SoFi, and to end on a positive note, we'll also cover Citigroup's most recent price target for SoFi, so stay tuned till the end for that. Hello and welcome to Wealth Gambit. On this channel, we cover the latest stock trends and research. If you like that type of content, like and subscribe, and hit that notification bell to get notified as soon as we upload any new videos. Also, please note that we are not financial advisors, and this is not financial advice, so always do your own due diligence. Without further ado, let's get right into it. According to the US Labor Department, inflation hit an all-time high of 6.8% year-over-year increase in November 2021, the largest 12-month increase since the period ending June 1982. The Labor Department says the inflation was primarily caused by the surge in prices for gasoline and other energy resources and with the prices for cars. And in order to put a stop to this seemingly unstoppable inflation, the Fed announced that it will raise interest rates in 2022 at its two-day policy meeting last December 14 through 15. On top of that, the Fed also announced that it will raise interest rates at least 3 times next year. So how exactly would this interest rate hike affect the economy? Higher interest rates would mean people eventually reducing their overall expenses to cope with the higher imposition of interest rates. And when there is a reduction in the market movement, there will be lower inflation. Now, what does this mean for all the lending businesses? Is this the end of all fintech lending companies?
What does it mean? What does it mean? What does it mean?
SoFi has 3 business segments: lending, its technology platform, and financial services. According to SoFi's Q3 report, its lending business represents a contribution profit of 14% during the quarter, the smallest profit contribution among its 3 business segments. SoFi investors like us are hoping to see higher results during its Q1 2022 results because the student forbearance loan is coming to an end early next year. But higher interest rates and higher costs of borrowing might put a little damper on its lending business once again. People might turn their backs on borrowing money to escape the burden of paying higher interest rates. But Anthony Noto didn't spend all that time in the trenches just to let something like this slow him down. He's got years of expertise in big time companies like Goldman Sachs and Twitter. Anthony Noto's got a plan for everything, and especially this.
Presumably, in doing so, you sacrificed a little bit on the volume side in order to get a higher quality of loans for your customers. Are you seeing the opposite to be true as well, where customers are kind of paring back their exposure to debt in order to kind of account for some of the interest rate rises and the potential for even more in the future?
Interestingly enough, periods like this that are discontinuous in terms of credit rates increasing creates an opportunity in 2 ways. People are reevaluating what they want to do, whether it's their SoFi money account versus their current checking or banking account, or their current lending or their current interest rate on credit cards. That creates opportunity for us to uniquely meet their needs. In addition to that, many of the current consumer services companies pull back. And when they pull back, that gets an opportunity to step forward.
Even though SoFi stock continues to dip at the moment, huge investment companies such as Citigroup have issued buy ratings on SoFi stock with a price target of $20 per share. Keep in mind, this is their price target currently. With everything going on in the market right now, it actually seems fair and doesn't really discredit SoFi in any way, so we see this as a win. It could definitely change within the near future. Regardless of what happened, this is still good news for SoFi. Comment down below what you guys think. We're not financial advisors, and the market has been rather unpredictable lately. SoFi's diversified products make it almost impervious to any changes in the economy. Changes in the economy that may negatively affect one part of SoFi's business will typically positively affect another. SoFi's diverse amount of products enables them to pivot when needed to avoid taking any major blows. Think Mike Tyson in his prime, but if he was also a ballerina. Fast and hits hard, but nimble and able to move out of the way of any major blow. News like interest rate hikes might hit one of SoFi's business segments, but it can't hit them all. That's it for today's video, guys. Are you buying more SoFi today? And if so, how many shares? Let us know your thoughts in the comment section down below. As always, if you watched this far into the video, comment Trench Warrior so we know who the true Sofian soldiers are and automatically get shouted out in the next video. Don't forget to like and subscribe as it helps the channel out a lot. Also, if you want to see more from us, then feel free to follow us on our social media platforms at WealthGambit. Until next time, peace.